Let's revisit some of the key incentives that came out of the pandemic to the banking sector, and later on we get your reactions.
Was well represented at a meeting in State House. The captains of industry fatigue and frustrated over a disease that is deliberately closing down the economy.
Those who unfortunately may be forced to take half pay or may be forced to be laid off for a period because hotels are empty and so on and so forth.
Lending and the country now facing the threat of job cuts and pay cuts, the lending rules had to be rewritten.
If you have a loan, personal loan, and it has been current on until March 2nd, and you are getting difficulties, particularly because of the pandemic, directly or indirectly, you can go to your bank and they can discuss with you extending it in various ways, including, as if at all the personal circumstances allow, could be even a sense of a moratorium. But the point is that it can be extended up to 1 year.
Small, medium-sized enterprises and corporate borrowers can also contact their banks to restructure their loans.
As March 2nd, anybody who had borrowed, you can go and negotiate that loan, because whoever is going to now go and negotiate a loan, of course they'll be taking into account the coronavirus. But to those who had borrowed before 2nd March, coronavirus that time had not hit the country, so the negotiations were not based on coronavirus.
The commercial bank's measures are also aligned to facilitate increased use of mobile money transactions instead of cash.
We obviously zero-rated transactions below 1,000. We made payments for medical services supply, that's medical services free of charge. We've also doubled the capacity if you're working from home on fixed wireless. We've fixed data.
President Kenyatta has also warned traders not to take advantage of consumers.
In this country has ever had a problem with somebody making profit. But indeed, it is highly immoral if we take advantage of an unfortunate situation to make super profit.
Businesses are slowing down and trade is practically coming to a halt. Telecom operators were the very first to move in, and today we did see the commercial banks. The question is, who will move next, even as concerns over coronavirus grows as it impacts the economy. Brenda Kirubu at State House, Nairobi.
All right, we continue with our discussion on the state of banking, and remember we are talking about this together with the CEO of Stanbic Kenya. I just want to pick his mind again. Sir, we saw a lot of mergers and acquisitions from the big banks acquiring relatively smaller banks. As a career banker, would you advise for this and also pair it closely with value to clients? Would you advise a bank to go into a merger or acquire another smaller bank, and does it assure value to the clients?
The decision about whether to merge or not to merge, I think it's always a shareholder discussion, which each bank would look at in their own circumstances. But clearly, as things become tough and the market, the share of wallet becomes smaller and smaller, you might find it prudent to merge in the instance that you feel that that would help your business. So clearly, some businesses felt that was prudent, and the situations like this always result in some rearrangement of any industry, not just banking, but across the world. We'll see this sort of mergers happening and acquisitions happening during periods like this. And it's an opportunity for businesses to reorganize themselves, re-strategize, and come up with new kind of outputs. So that is expected in situations like this.
That said, though, Kenya has about 40 banks, 40 licensed banks. Nigeria has about 4 of them, which are the key big banks that run almost the prime, projects in Nigeria. What's your take on that? Are we overbanked as a country?
I don't think we can say we're overbanked, because the market has a way of finding its own level. So as long as that bank has got customers that are saving it and is supporting the industry, I think the competition is good in any market. It gives the consumer a wide choice, and it gives the people the right to be able to get whatever services. And if you look at all the banks, they're not running exactly one strategy. There are some that look at SMEs, there are some that look at youth, there are some that look at corporates, and then there are some that are just broadly universal. So each bank has got its own niche and play where they play, and each customer has the right to choose what they feel best suits their needs. So it's a good choice for customers to have, rather than be restricted in a situation like that. And the market, as I've said, that should the banks not be able to sustain that market and they feel they can sustain it, they have a right then to look and say, how do we sustain this and move? If they need to merge, then they will be able to force to merge.
That said, what is the effect of the financial reporting standards to banks?
Well, I mean, standards will always come in. I think they are supposed to make us safer. I'm sure, as you all know, I mean, we after the financial, crisis in 2007, 2008, we saw the emergence of Basel standards coming up much more prominently, requiring us to look at more how we provide our capital, how we ensure that we provide standards that guarantee safety to people. I mean, banks, somebody said to me once in one of the countries I worked with as a Minister of Finance, he said banks are the only privately owned public institutions. And I think that is true in many ways, that in as much as they may be privately owned, we provide a public service. And therefore, it is important that there's trust and confidence of those banks into the public. And regulation plays to give that level of confidence to the public, that they can be assured that there's proper oversight and that there's prudential guidelines that govern or guarantee people the safety of the money that they've put in. And as a result, regulations that are put in place are meant to do that. Now, the current regulations that we have, and I think the one you talk about is IFRS 9, I think, which came into effect almost 2 or 3 years ago.
Sure.
I think the critical thing about it was that how do we improve how we account for impairments and how do we improve how we account for valuation of certain assets that we have. And the idea here was to ensure that rather than looking at a historical perspective of bad books or bad loans that we have, we also start looking at a futuristic experience so that we manage what we call expectations. In other words, even if I give a loan today, when I look into the future, what does it mean? Because looking into the past, it has already happened, but we must look at the future and say, will I be able to guarantee that the loans that I'm giving today will not create a problem in the future? That's improving the safety of the industry and therefore giving much more security to people who are putting their money in the banks.
Amazing. There's a big digital revolution right now. Could you tell us the position of fintechs in mainstream banking, if I may call it that?
I think, one thing that I've seen, today I was listening to a conversation that was happening on European banks this morning, and they were discussing the fact that digital innovation is going to accelerate because of COVID. And I think there's a joke in the market where people said, what is the biggest driver of digitization in your industry? And I think people had a whole lot of series there, including the CEO, the chairman, the regulator, etc. And people said then COVID, and everybody kept saying COVID forced us all to think much more than we did and accelerate the pace at which we're working. And that will not stop. I think what is done now is to get us a taste into the future and got us to think differently. So as a result, we are seeing a lot more collaboration with fintechs and how we can bring that technology into the banking industry. We are also seeing a lot more innovation happening with the banking industry as more and more people move into transactions. If I give you an example, for example, at Stanbic, we found that, for example, during COVID, we were opening almost 95% of the accounts that we opened last year were all opened digitally because people didn't go to the branches. They were all transacting digitally. We are seeing that almost over 80% of our customers are actually transacting digitally for all their day-to-day products. So we've seen that shift as more and more people are starting to operate on the digital platforms, using the digital platforms and being able to operate with them. Even myself, I found myself that normally my office is upstairs and the branch is downstairs. And typically when I need to do transactions, I'll just go downstairs and transact. But with COVID, I was sometimes working from home or somewhere. I couldn't walk down to the branch anymore. So I found myself sitting on the digital platforms. And I know my relationship manager said to me once that for the first time, we're going to fix all the bugs in the bank because you are now experiencing what your customers experience every day. So we all had to learn to do digital things during this period, which is great.
As we bring this to a close, that's a very interesting observation there. As we bring this interview to a close, what is the resilience or recovery strategy for Stanbic, even as the whole economy continues to try and recover from the effects of COVID-19?
I think what we have said is that as we work with our customers and start to see how they operate in this market, the one thing that we've realized is that it's good to be partners with your customers. So our purpose is Kenya is home, we drive a growth. And we believe that we must partner with our customers to drive their growth. And part of that partnership means that we join with them and work with them. So we're the first bank to reschedule loans on COVID. It happened last year. And by the end of the year, we'd reschedule 38 billion shillings worth of loans. We are now looking and say, what is phase 2 of that process? And customers are coming back to us to say, this is where I want to be, and how do we partner with them? And we are partnering with customers to help them either restructure their loans, restructure their businesses, or look at new business opportunities. As you know, we launched recently our new payoff line, It Can Be, in our Sekana. And we are saying we have to be able to fulfill dreams, because with or without COVID, life must go on. And we must all look into the future, and we say it can be.
It can be, indeed. And of course, Mr. Charles Mudiwa is originally from Zimbabwe, and to hear him speak such good Swahili, we were chatting with him earlier on, and he tells me that Swahili, being largely a Bantu language, is not far from his native language in Zimbabwe. A career banker, has been with Stanbic for years and years now, was CEO in Lusaka, Zambia, and now is in Nairobi as Stanbic CEO. Thank you so much for joining us in this conversation on the state of banking. So it was good having you in studio. Let's now go to another exciting weekly segment, The Adventurer.